Okay, welcome to session 9 of Sharpen Your Edge. I'm glad you're here. I'm Tim McKee, and today we're going to talk about, oh, let me get my cursor correct here. There we go, about why price moves. Let me get rid of those. Okay, we're going to have a discussion today about why price moves, but it includes necessarily a discussion of what options are and how options function and how they drive price. And then I'm going to tell you also why options move, but we're going to do some explanation of what options are. So options are leveraged financial instruments known as derivatives, right? Because they derive their price from something else. Prices are derived from the value of the underlying assets, such as stocks, currencies, interest rates, commodities, even market indices, such as the FTSE 100 or the S&P 100. How do options work? Well, options have a expiration date, which means they have a very limited lifespan, really depending on where the expiration is. For instance, our expiration is always tomorrow. For Keith, it's next week. If the option expires in the money, and that is anything in the blue field on your option chain, the holder can exercise the option and buy or sell the underlying asset at the predetermined price. Now, if the option expires out of the money anywhere in the black area on your option chain, the holder, you and I, will not exercise the option and it will expire worthless. Now, it's rare that we would ever let something expire worthless, mostly because most of what we take is in the money. Now, it can fall out of the money very easily depending on how price is moving. But that's one of the reasons why we at least start in the money. So how do options work? Well, at the money describes a situation when the strike price of an option is equal to the underlying asset's current market price. Every morning when I go to the option chain and talk about underlying volume and what strikes we're going to start at, we always start at the money. It's the first blue field on your option chain. What type of options? Well, there's calls and there's puts. Now, a call option gives the holder the right, but not the obligation to buy the underlying asset at the strike price on or before the expiration date. Now, investors typically buy call options when they believe the price of the underlying asset will rise. Now, investors also buy options as an insurance, which is why what we pay for them are called premiums. All right. They're done as a hedge. If investor takes a large position in Apple, he may also take a relative large position opposite of that in options as a way to curb any downfall. Puts. Now, a put option gives the buyer the right, but not the obligation, to sell the underlying asset at the strike price on or before the expiration date. Now, investors typically buy put options when they believe the price of the underlying asset will fall. And again, investors will use it as an insurance policy against a large position, say in Apple. What are components of an option contract? Well, the underlying asset, that's the financial instrument that the option is based on. In our case, QQQ or SPY, can also be stocks, bonds, commodities, or market indices. You can option almost anything in the stock market. Strike price, the predetermined price at which the option holder can buy or sell the underlying asset. We work with strike prices every day. That's how we determine at what level we're going to buy an option. What are the components of an option contract? Well, there's also the expiration date, the last date when the option can be exercised. After this date, the option becomes worthless. So tomorrow at 4:15, anything that we've bought today and held will become worthless. The option premium, the cost of purchasing an option paid by the buyer to the seller. Now, when we're on the option chain and we're paying that price, not all of that goes to the seller. That gets split up to the platform and the market maker and taxes and fees as well. Option style. Now, this is interesting. Determines when an option can be exercised. There are two kinds of styles. There's the American, which we can exercise anytime before expiration, and there's the European, which can only be exercised at the time of the expiration, which goes a long way to explain why American options are far more popular in Europe than European options are. I don't know anyone who's traded European options. How are options priced? Well, the market forces affecting the value of the underlying asset will in turn affect the market value of the options attached to that asset. It's all based on the underlying option. The option itself has no underlying value. Its value is derived from the asset itself and your ability to buy and sell that asset. But that said, options run on their own supply and demand. And the internal market forces that really affect pricing are, number one, first, the market maker and the will of the traders. Now, the market maker is very aware of the will of the traders, because on their level 3, they can see order flow, orders coming in, orders going out, and they can see where stops are accumulating. So based on that information and based on the will of the investor, or in our case, speculators is really more what we are, depending on if we are buying, if we're in a buying mood, or if we're in a selling mood, will determine to a large part the direction in which price moves. As the market maker moves price one direction or the other, let's say the market maker is moving price up toward a call direction. As long as we as speculators continue to buy up that price, the market maker will continue to move that price up, trying to stay ahead of what current buying is going on. And that's purely on the option side. Yes, in a greater sense, since options are tied to an underlying asset, as that underlying asset moves, so does the option price. But keep in mind, and this is important, that the options do run on their own supply and demand and can move against the underlying asset at times, and often does every day. Even though the option itself has no underlying value, the fundamentals of option pricing. Understanding option premium is key to option trading. There are two fundamental components of an option price. These components are intrinsic value and time value. So option price is made up of intrinsic value and time value. Intrinsic value, and I think that's on the next slide, what an option is actually worth if it expires now is the intrinsic value. Now, only options that are in the money, ITM, can have intrinsic value, because if they were out of the money, they'd expire worthless. But until expiration, even being out of the money still derives value. Until the delta gets down to zero, there is still value in that. So as long as you exercise that option before expiration, you will still collect some money. You won't make any money, you'll lose money, but you won't lose the entire investment. So time value is made up of time to expiration and volatility. So how is an option priced? Well, the price of an option is influenced by the price of the underlying asset. So when the price of the underlying asset goes up, the value of the call option or the right to buy generally increases, because there's a greater likelihood of making a profit if you can buy the asset at a lower price than its market value. Now, the other side of that is when the price of the underlying asset goes up, the value of a put option, which is the right to sell, generally goes down because there is a lower chance of making a profit if you can sell the asset at a higher price than its market value. Really, the bottom line is when the price of the asset rises, call options become more valuable and put options become less valuable. When price goes down, it's the exact opposite. Strike price. The strike price is the predetermined price at which the underlying asset can be bought or sold when exercising an option. So for call options, a lower strike price means that the option is already closer to being in the money, and because of that, it's more valuable. And then on the other hand, for put options, a higher strike price brings the option closer to being in the money, making it more valuable. Now, I know this is a lot of technical stuff, but it's important. Okay, the next item that determines price in an option is the time to expiry. The time remaining until an option's expiration date affects its value. Now, options with more time until expiration have a higher likelihood of experiencing price fluctuations, giving the underlying asset more opportunities to move in a good direction for the option holder. As a result, options with a longer time to expiration are generally more valuable than those with a shorter time per expiration. This is how time decay eats away at the value of our option. This is one of the reasons why Randy trades out a week. It gives him less time decay because time decay is in a parametric, it's parabolic in the way that it moves. That is, time decay is faster at the end than in the beginning. Randy gets an extra couple of days of much lower time decay than we do. But our intention is when we're in a trade is not to hold it that long anyway. It's only in extreme circumstances that we would hold something if we're waiting for it to come back. Would we wait that long? Rarely, if ever, do we hold overnight. Now, Keith can hold overnight easily and get away with it without getting hit too hard. But that time to expiration is really important. Next, volatility. Now, volatility refers to the degree of price fluctuation in the underlying asset. So higher volatility means there's a greater potential for significant price movements, right? Which increases the probability of an option becoming profitable. Therefore, higher volatility leads to higher option premiums as investors are willing to pay more for really the higher chance of substantial gains. And that is how price moves. But I think one of the big, besides all this technical stuff, one of the big takeaways I want you to remember is that price moves and is motivated by the will of the speculators who are in buying it up, FOMO, increasing that price, and when they're selling off, when their desire is to sell off. The market maker makes that happen, coerces the market above what the speculators are buying and selling for to keep the market moving. That is what the market maker does. It keeps the market moving, and option traders create volatility by buying and selling at times at unreasonable rates. Now, today we've seen some incredible price movements in the price today. So that is really it. I've got one more slide for you. Resources. Great resource is optionsdesk.com. It's basically an encyclopedia of options. And this is a great book, The High Probability Options Trader by Marcel Link. This is a great book. I got this recently myself and has great explanations. So that's it for today's lesson. Does anybody have any questions? Just go ahead and unmute yourself and jump on in.
Hey, Tim, this is Keith.
Hey, Keith.
one other thing we may want to address is to why do we trade options versus just buying the underlying QQQ?
Mhm. Do you want to answer that, or you want me to answer it?
Well, I think a couple reasons for it. Number one, if you buy the underlying, it's got to go up to make money. It can't go down. So if we're trading in a down market, you just wouldn't trade or you would be losing money.
Mm-hmm.
Also, we're leveraged more. The price of the premiums are significantly less than the underlying. You know what are we like $460 if you bought the underlying, but for us we're maybe what paying $3.50 for it.
Mm-hmm.
So percentage moves, assuming we can predict which way it goes and can control when we get in and get out, we get a higher percentage gain for the same movement in the market that the underlying would have.
Yeah. Yeah, absolutely. That's, I think, one of the great attractions is the high leverage of options. And as Keith was just saying, let me see, current price of the underlying is 466, and right now we can get a control. We don't own it, we're just borrowing it. We can borrow 100 contracts for $269. Not 100 contracts, one contract which controls 100 of the underlying asset.
100 shares.
100 shares. Thank you, Mark. Um, so it's highly leveraged. Often, well, no, I'm just going to make a statement that's not true. So forget that. Okay. Anybody else? Anybody else have questions or comments?
I think someone types a question in the chat box.
Okay.
Keith, can you explain why you do trade options a week out?
Yeah. The reason I do it, and it isn't necessarily a week. It's like 3 days to a week out, is because it does give me more time if I feel the charts are really in the right place, particularly the long-term charts, that I don't have to jump out of it and settle for earlier one. Now, as it turns out, all the testing I've done for the last 3.5 months, I've never once had to hold it overnight. Now, yes, granted, I did a test thing last week, but generally speaking, I haven't had to hold those overnight. So I've been coming in a little bit closer to the current trading day and expiration. That's why, like today, I traded Friday's expiration. So we're 3 days away there, and but it gives me a little bit more comfort and that I have more time to deal with it. Now, with that, I give up. First of all, they're more expensive. So if I'm trading, say, $1,000, I'm going to trade fewer contracts than if I was trading tomorrow's expiration. Plus, percentage gain, you've heard me say a couple times, say a 50-cent gain is different for me than it is for Tim. For Tim, that's a higher percentage gain that he's getting than I'm getting. So I give up a little bit by going out further in time, but not a whole lot. And to me, it just gives me a little bit more comfort.
Yeah. Yep, absolutely. And Mitchell asks, what about buying and selling the futures contracts? Buying Q where you buy a call, selling Q when you fall. You could do that. And there's actually several people during our morning session that does futures based on our calls for that. Other than that, I know almost nothing about futures. But
Same here.
yeah, so I'm not really qualified. Mark, do you have any insight?
No, I think, you know what, you're trading futures. There's risk, of course, just like there is in options. But at least the option gives you some kind of catch or stop, because the premium is your maximum exposure. Okay, So even if you're wrong, theoretically, you put $300 in an option, that's your maximum exposure on that option, you're done. Whereas if you're in the futures market, the market goes against you, you could be at risk for more than $300 because you're actually in the futures cash market, and therefore you have unlimited risk. So we have a stop, I call it, with the cost of the premium. I think that's the big differential for me.
Yeah. Yeah. So that's good. Mitchell says, I understand. Okay, great. All right. Any other comments or questions? If not, I'm going to stop the recording and